Facebook friends and family, we are live, alive, and I have Greg Foss joining me any minute now. Um, where is he? Okay, he's got the invite sent. We're good to go. So I'm just waiting for Greg Foss, mortgage specialist with Mortgage Line, to join on. And Greg, how are you, brother? You should have an invite there to jump in here. Let me know if you have any troubles. We'll kick you in. Just letting everyone know that we are going to be talking about variable versus fixed rate mortgages right now, and why that's important to you in today's economy, right? And we just had a great chat on Instagram Live about this, and obviously had to bring it to you guys too. So first of all, I hope everyone's having an amazing day, and we're really excited to do this. We're really excited to bring this info to you. Here we go. I'm gonna add him here. Here right now. Give me a second. Hey, Monique, how are you? Red Shoe Realtor in the house. Greg, how are you, man?
Hey, good Peter, how are you?
Great, thank you. Can you hear me okay?
Yeah, you bet. Can you hear
I
me?
can. Awesome. Thank you again for joining me. I was just telling everyone we had an amazing Instagram live feed, and we obviously had to share with all our Facebook friends and family. So, real quick, I guess we're just gonna kind of talk about some variable mortgage rates, and how that's an advantage for people maybe looking to buy a home today.
For sure.
Yes.
Yeah,
So real quick,
let's do it.
can you just break down for everyone the difference between a variable and a fixed rate?
Yeah, for sure. There's a lot of misconceptions about variable versus fixed, and so variable is much like its name. It can vary. The interest rate can go up and can go down based on prime rate, which is set by the Bank of Canada. Fixed rate is fixed, and you can sign a 2, 3, 5, or all the way up to a 10-year contract with the bank. So variable is going to fluctuate a bit, possibly, and fixed rate is going to stay the same.
Right. So off the top of my head, fixed sounds pretty safe. I like things staying the same and know what I'm getting into. Variable, like you said, it's kind of like juggling, right? You're up in the air. So why would that be an advantage of not knowing how my mortgage rate is going to go?
Sure. It's education, pure and simple. Once you realize that variable rate product is not this scary monster that a lot of the banks make it out to be, is it's a fantastic product. There's a lot of things built inside a variable product that gives you peace of mind and an escape strategy that when you look at both variable and fixed, you're probably going to realize that you should realize that fixed rate is technically more risky than going with a variable rate product.
Why is that?
Well, the thing is, imagine it's almost like taking a cell phone contract. Think of your fixed rate like a cell phone contract. Imagine going into Telus or whoever and saying, okay, I'm going to sign my 2-year cell phone contract. And then a year later, you go in there and say, I don't want it anymore. I'm going to go with these guys. What are they going to make you do?
Pay. You
Pay
can get
big.
out, but you will
Pay
pay.
big. Exactly. And that's just what's going to happen with a fixed product. They're going to say, hey, you know what, Peter, great. You said you're going to sign this 5-year product. You still owe us 3.5 years, 2.5 years worth of interest rate. They call that an IRD, interest rate differential penalty, that is buried deep down into the deep parts of the mortgage paperwork.
Right.
And they'll make you pay that. That's a legal document. They'll make you pay. And with a variable rate product, is it has an escape strategy. You are able to break that product at any time with a 3-month interest only penalty.
Oh,
So it might be a couple $1,000 you're able to get out of that mortgage at any time. Reason why that is so crucial is why I don't understand as a mortgage broker is that when you are looking at what most Canadians do is they keep their mortgage for 3 years. It's a stat. It's out there. You can research it. They keep it for 3, maybe 3.5 years, and then they do something with it and they break it. Divorce, separation, selling, refinancing, doing something with it, and guess what? That penalty comes into play.
right, right. So ultimately, what I'm hearing is variable, you have options. You have a lot more options to move and flow with how life goes, right? Like you said, things change every three
Yeah,
years kind of thing for people. So that definitely makes sense to have that option and not really have to pay, right?
yeah.
To make those kind of different life choices if they come up.
That's right. So I always say, whenever I meet with a client, I always ask them, okay, in 5 years, this is a huge decision. It's 2018. If you could go back in 2013, would you be understanding where you are right now? Did you know all these things and that 5 years was going to happen in your life? Probably not. There's
Right.
probably a few surprises in there. And I see it on my end, and it's heartbreaking when people are like, "Hey, got to break this mortgage," and you're like, "Oh my goodness, like this is not going to be cheap."
No problem, but right? Yeah,
Yeah,
we can do
we'll do
it.
it, but yeah.
Yeah. It's more, yeah, how will you like it, right? What's happening tomorrow with the Canadian government?
Right. So getting back to fixed or variable is the variable rate mortgages are tied to prime rate. So when the Bank of Canada adjusts that, they're the one in control of that. They'll say, okay, prime rate is going to go up. Then your variable rate mortgage will go up with that. So the Bank of Canada makes that decision 8 times a year, and tomorrow they'll make their decision if they're going to raise it or lower it. And there's a very, 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 very good chance it'll just stay the same. They're not going to touch it.
Okay, okay. And is that your prediction that there's a good chance it's going to stay the same, or is that the buzz in the community?
That's the Yeah, that'd be the buzz. Yeah, that's
Yeah.
that's a lot of research. Yeah, as a mortgage broker, that's something we're always monitoring. We're always checking to see where the markets are at to see, okay, are we going to see that fluctuation, that bump? And right now, there's about a 1% spread between your variable interest rate and your fixed rate.
Okay, cool. Well, thanks for all that information. So real quick, let's give everyone at home. I like examples. I like things simple so I can really understand because when we're talking rates and percentages, I don't know. That's why I have you, right? Can
Right.
we put this in perspective for people of what the variable mortgage would work, how that would work for them, and an advantage of how they can pay off their mortgage faster?
For sure. When we get into mortgages, we touched on this briefly, is that on the Instagram, is that when you're getting into your mortgage, it's astronomical how much interest you're paying. And if we can get into, especially in the first 5 years, if we can get you into a product that'll be dropping that amount of interest you're paying, is going to be huge. So let's say right now a 5 year fixed mortgage is 3.45%. Your variable rate is 2.45%. Hypothetically speaking, let's just say that's a $200 a month difference in just interest. What I would recommend is that you take that $200. If you were coming into the meeting thinking, I'm going to do fixed, you already would have been paying that $200 more. So then take that extra $200 that you're saving when you switch to a variable and put that right onto principal. So you bump up your payment by $200 a month, and that goes right onto principal.
Right, nice, nice. And like you said, even if the variable rate goes up, would you anticipate it would go up that much, $200 for people? Like, would it be a pretty bad scenario if it went up that high?
Yeah, oh yeah, like the government of Canada knows that they can't just keep pounding that. They can't just keep raising that, raising it, because they'd just be a ripple effect throughout the economy. They raised the interest rates, the prime rate, to slow down the economy. So if our economy is not doing so great, that's why they're leaving it the same, is because oil, there's all these different things going on right now that it's not doing so great. So yeah, there's very, very low risk of that rate slamming up to an astronomical amount. The Canadians, we just don't operate that way as a
Right.
Canadian government. So yeah, we're very stable, and that's why people love Canada.
Right.
So yeah, so it would be incrementally raised, and that $200 extra a month, you're bumping up your payment. If that's a problem, you can just lower your payment. If the prime rate goes up, you can lower it, but you're already ready. Then that's the whole point, is you're hedged. You got that buffer in
Yeah,
case it does.
and that's the point I was trying to make as well, is that you're putting that $200 down on the principal. Variable rate goes up, let's say $100, for example. You still have that $100 going down on the principal, even with the rates going up, and then there's chances it would go down. Quick question: How I mean, is there a kind of a timeline that people would expect? Say the variable rate goes up. I'm in a variable mortgage right now. My rate just went up the $100 or whatever it is a month. Is there a bit of a timeline that you would ever expect that to change again, whether it go up higher or lower?
Uh, yes, in a way, if you keep an eye on what's going on in the economy, you can start to feel if there's going to be rate increases. And usually, if there is going to be an increase or decrease, there's a lot of buzz in the news about it.
Right,
So right now, it's been dead. There's not been much talk because they pretty much know it's not going to raise it. So
right.
yeah, when you get into variable, we were touching on the Instagram video, is if the government was raising the rates up, you'd be having to see four times they'd have to raise that before you'd even be matching what you're at with a fixed rate.
Right.
And the chance of the Canadian government saying, God, our economy is doing so well, we're just going to keep ramping that up is very rare. And there's probably a good chance you'd have to see it almost go up about 8 times before you're actually going to be paying more than you would see on a fixed.
Right. And the likelihood of them raising it 8 times is, like you said, we're in Canada, that's probably not going to happen, right?
That's right.
Okay.
Yeah. And then if it does, you have that escape clause where you can get out and you can switch it to a fixed if you feel like you need to.
Right. So ultimately, what I'm hearing is contact you if you have questions, and reach out to your mortgage specialist, your bank, whoever you need if you feel like that change is happening and you just want to have that discussion. It's really, you don't have to make changes. You could have the discussion and just better educate yourself in the moment, right? Which is a huge advantage for people.
That's right.
Cool.
Yeah.
Cool.
I agree.
So, well, thanks for joining us, Greg. Is there anything else you want to, do you have any future predictions? Anything you just want to say?
Yeah, I think that the biggest tidbit is research. If you're looking for a mortgage, refinance, whatever you're doing with your mortgage, research it and then go into that meeting prepared and have that conversation, variable fixed.
Awesome. Awesome. Yeah, go in with some info to ask questions instead of being told how it's going to go for you.
Yeah, absolutely.
Right. Okay, Greg, really appreciate it, man. Look forward to the next one, and thanks everyone who joined us today. That's fantastic. We had a good crew here, so I hope everyone has an amazing day, and we'll see you guys around the community. Take care.
Thanks, Peter. See ya.